So the stock market recently took a big dip. Let's play the clip.
Welcome to Meet the Press Now. I'm Brian Nobles in Washington as we begin with breaking news on Wall Street after a tumultuous day for markets across the globe. At points today, the Dow was down more than 1,000 points, driven by uncertainty about the health of the U.S. economy.
We are covering a global market sell-off this morning. This is underway right now. Now, the NASDAQ entered correction territory on Friday, but we have seen...
I know days like today make you want to cry yourself to sleep. But you know what? This is indeed a normal yet incredibly nasty sell-off.
Hey everyone, welcome back to the channel. If you are new here, my name is Krista Tyus. I am an enrolled agent by the Internal Revenue Service, and I am dedicated to helping you navigate the complex world of taxes and finance. So today I'm excited to introduce a brand new daily series where we will delve into the latest and most important news in tax, accounting, and finance. So whether you are a tax pro, a small business owner, or you're just interested in staying informed, this series is designed to keep you up to date with the information that matters most. So in today's episode, we are going to discuss the recent dip in the stock market, its implications on your taxes, and some strategies to help you manage your investments more effectively. After all, we're all looking to pay the least amount of taxes. So we're going to talk about how you can do that. Now, before we dive in, don't forget to hit the subscribe button. Do me a favor, ring the bell so you never miss an update. And if you found this video helpful, please give it a thumbs up and share it with your friends and colleagues. All right, so the stock market recently took a big dip. So if you've been wondering how these fluctuations can affect your taxes, this video is for you. Today, we'll delve into the tax implications of stock market gains and losses, and we'll share some tips on managing your investments to minimize your tax burden. So first and foremost, when you buy and sell stocks, your transactions can have significant tax implications. So it's important to understand the differences between a short-term capital gain and a long-term capital gain. And most importantly, how these types of losses can affect your tax return. So what exactly are these? Now, for those that are already familiar, this is going to be a beautiful recap. But for those that are new to this concept, let's go over a brief explanation. So one, a short-term capital gain is profits from selling assets that you have held for 1 year or less. So 365 days or less. These gains, they are taxed at what's called your ordinary income tax rate. Now, what's your ordinary income tax rate? So the United States tax system has what's called a graduated income tax rate. So that means depending on how much money you earn, will depend on your particular tax rate. Now, as you see, the highest rate is 37%, depending on your income level. So when you sell short-term capital gains for a profit, you are going to be taxed, or those gains are going to be taxed at your ordinary income tax rate. So you see, it typically is not going to be as favorable for you. Now, let's look at the long-term capital gains rate in contrast. Now, this is where you have an asset that you have held for more than 1 year. So more than 365 days is what? 366 days. So if you held the assets for 366 days or more, these gains are taxed at a lower tax rate. This is called the preferential tax rate. Now, as you see here on the long-term capital gains rate chart, taxes can be as low as 0%. So that means investors that have held their assets for more than 1 year and they sell it for a profit, they could potentially pay 0% on a good portion of their profits. Now, again, it's graduated. So as you have and make more money would depend on your long-term capital gains rate as well. But we see here that the highest tax is 20%, with a median being about 15%. Now, Warren Buffett is notably quoted to say that he pays less taxes than his secretary. Now, if you think about someone like Warren Buffett, he probably, we know, have a lot of stock investments that he has held for longer than a year. So when he goes to sell these assets for a profit, we see here that the highest rate that he pays is 20%. Now, in contrast to that, if we take an executive assistant to a CEO of a Fortune 500 company, we see here that they can make as high as $142,000. And if we look at the tax rates for a single taxpayer, we see based upon a graduated tax rate that their taxes is going to average somewhere around 22 and 24%. So even with this simplistic example, we can see how a billionaire like Warren Buffett is paying less in taxes because they are leveraging long-term capital gains versus a W-2 wage earner is paying as high as 37% on their wages. Now, this is important because if you or your clients are monitoring the stock market and you're making decisions without taking into consideration how long you've held an asset, it can greatly affect your tax situation. So if you are irrationally selling your stock when you see that the stock market has taken a dip and you sell it for a profit, we hope and pray that you have held it for longer than a year, or it's going to be taxed at your ordinary income tax rate. Now, when the market dips, it can be a good time to consider what's called tax loss harvesting. Now, this strategy involves selling investments at a loss to offset gains elsewhere in your portfolio. This can reduce your taxable income. So let's look at a quick example. So let's say you have $5,000 gain from one stock and a $3,000 loss from another. You can offset the gain with the loss, resulting in a taxable gain of only $2,000. This is called tax loss harvesting. Now, you do want to beware of what's called the wash sale rule. This is a rule that disallows the deduction of a loss if you purchase a substantially identical investment within 30 days before or after the sale. So again, pay attention to the timing of when you are selling your asset. Now, the next thing I want to talk about is dividends in your taxes. So one, you have qualified dividends, and then you have ordinary dividends. Now, dividends are a distribution of earnings, often quarterly, by a company to its shareholders, and it can come in the form of cash or a stock reinvestment. So some notable companies that issue dividends is IBM, AT&T, and General Electric. Now, the tax treatment is different between a qualified dividend and an ordinary dividend. Now, your qualified dividends, they benefit from the lower tax rates, which are the same as the long-term capital gains rates, meaning you can pay as low as 0% on your qualified dividends all the way up to 20% depending on your taxable income. Now, there are requirements to qualify dividends. So listen to this. You must have held the stock for more than 60 days during a 120-day period that begins 60 days before the ex-dividend date. So this is the date after which you won't receive the next dividend. Now, if you or your clients meet these requirements, your dividends will be qualified. And again, you will get the preferential tax rate, a lower tax rate. Now, if you or your clients do not meet these requirements and you are issued a dividend, your ordinary dividends are going to be taxed at your ordinary income tax rate, which we noted can be as high as 37% depending on your income level. Now, the next consideration that we want to talk about is your retirement accounts and market fluctuations. So if you are invested through a tax advantage account like an IRA or a 401k, you probably had a heart attack the other day when the market declined. Market fluctuations, they have different tax implications. Now, what's notable is that gains and losses in these accounts typically don't affect your taxes until you start taking distributions. Now, you're going to see your balances fluctuate as the market fluctuates. It's going to go up, it's going to go down. We know that most investments can be cyclical. The key is that you aren't affected until you sell the assets that are being invested through your tax advantage account, your 401k or your IRA. So again, if you're making decisions, rash decisions based upon how the market is performing without consulting a tax professional, your financial planner, you could make some decisions that can actually hurt your tax situation. Now, on the flip side, if you have a Roth IRA, Your contributions that you made were with what's called after-tax dollars. And so any withdrawals that you make are tax-free. Now, here's what you want to understand when you're managing your investments for tax efficiency. One, hold investments long-term. If you want to take advantage of the long-term capital gains rate, you want to consider holding your investments for more than 1 year. So be patient as you see the market fluctuating. If you are investing correctly, you should come out on top in the end. For example, if you look at the S&P 500 index, since its inception in the 1920s, it has averaged a return on investment of 9.9%. So we can round it up to 10%. So again, if you hold long-term, you're going to see these market fluctuations, but over time, you should be trending with an ROI on your investments if you are invested correctly. Now, when I say invested correctly, what this means is, do you have diversification within your portfolio? Now, this is really important because there's the old adage, don't keep all your eggs in one basket. And there's a reason for that. So let's talk about some ways in which you or your clients can diversify their portfolio. So number one is equities or stocks. Now there's different types of tiers of stocks that you and your clients can invest in. One, you have your large cap stocks. So these are shares of large established companies with a market cap of $10 billion or more. So you can think Apple, Microsoft, Johnson & Johnson. You have your mid-cap stock. So these are shares of medium-sized companies with a market cap between $2 billion and $10 billion. So you can think companies like Autodesk and JetBlue. You have your small-cap stocks. So these are smaller companies with a market cap between $300 million and $2 billion. You can think companies like Crocs and Planet Fitness. And then finally, you have your international stocks. So this is where you invest in companies outside of your home country. Our home country is the United States here. So we can invest in companies like Alibaba, which is based in China, or Nestle, which is based in Switzerland. Number two is index funds and ETFs. So you can invest in the S&P 500 index fund. I just talked about that. That yields on average about a 10% return. What this is, this tracks the performance of the 500 largest publicly traded companies in the United States. You also have total market index fund. So this offers exposure to the entire stock market, including large, mid, and small cap stocks. So typically, if you go and you talk to a financial advisor, they probably are going to put you into one of these buckets. They might put you into the S&P 500 index fund or total market index fund because it's pretty consistent and they're pretty much going to guarantee you an ROI because historically, since the 1920s, index funds or ETFs have proven to be an ROI because you are invested in a bucket or a pool of the largest companies, or between large, mid, and small cap companies. Rounding out the index fund and ETFs is what's called your international index fund. So this is going to provide exposure to markets, again, outside the United States. Number three, you have bonds. This is going to provide fixed income. So a part of your portfolio, you can invest in government bonds, which is debt securities issued by the government, such as the U.S. Treasury bonds, which are considered very low risk. You have corporate bonds. These are debt securities issued by companies. These typically offer higher yields than government bonds, but of course they come with a higher risk. And then you have the muni bonds or municipal bonds. So these are debt securities issued by state and local governments. Now, these often offer specific tax advantages. Number four, you have commodities such as gold, silver, oil. Gold is often used to hedge against inflation and economic uncertainty. Silver, another precious metal, and then oil. Investing in crude oil or energy-related commodities can provide exposure to the energy sector. Number five, you have real estate. Now, you can invest, obviously, buying individual or multifamily real estate is always typically a tried and true American way to build wealth and to diversify your portfolio. But you also can invest in what's called REITs or real estate investment trusts. So these are companies that own, operate, or finance income-producing real estate. This typically is going to offer a way to invest in real estate without buying property directly. Number 6, you have alternate investments. So cryptocurrency is high on the list of alternate investments. So this is digital or virtual currencies such as Bitcoin or Ethereum. These do offer higher risk, but potentially higher reward. You have private equity. These are investments in private companies, which are not publicly traded, often involving higher risk and longer investment horizons. So before Facebook became Facebook, it was traded on the stock market. Smaller investors or private equity companies or angel investors invested privately into these companies before they became public. And when they became public, they reaped huge, massive ROIs. And it comes with higher risk. But if you invest privately in the right company, as it scales, as it grows, as it goes public, you can reap large returns. And then finally, you have global investment. So you can invest in emerging markets, which could be investments in developing countries that may offer higher growth potential, but also come with higher risk. You can invest in developed markets. This is established economies outside of the United States that's going to provide stability and diversification. So if you look at the mix of how you or your client should be thinking about diversifying their portfolio allocation, typically you want to have 60% of your investments in equity, so stocks, and you want to break that up between large cap, mid cap, small cap, and international stock. Or again, you can just invest in an ETF. Number 2, you want to have about 25% of your investment into bonds. This is going to be about 10% in government bonds, 10% in corporate bonds, and about 5% in muni bonds. Number 3, you want to have about 10% in commodities. So you can have about 5% in gold, 3% in silver, 2% in oil, and then finally about 5% of your investment in real estate or real estate investment trusts. Now, by diversifying your portfolio, again, you are going to help manage your risk and reduce the impact of market volatility on your portfolio. So again, you're not having all of your eggs in one basket. Now, the final tip to manage investments for tax efficiency is consult a tax professional or a financial advisor that's going to help you create a tax efficient investment. So you can go to certifiable.com, click on the coaches and mentors tab, and you can find a qualified tax professional or a financial advisor that you can hire to help you navigate not only your investment portfolio, but your taxes as well as your accounting. Now, this is for you if you are individual, you are individual investor or W-2 worker. And this is also for you if you are a business owner or a combination of both, because nowadays a lot of people are and have part-time hustles on the side. So let's do a recap. Understanding how the stock market affects your taxes is crucial for effective tax planning. So remember the differences between short-term and long-term capital gains. Consider tax loss harvesting and be mindful of how dividends and retirement accounts impact your tax situation. So if you found this video helpful, please give it a thumbs up. Subscribe to my channel for more tax tips and financial advice. And if you have any questions or topics that you would like me to cover, leave them in the comments below. Thank you for watching, and I'll see you in the next video.